Another day, another Italian government. Matteo Renzi, expected to be sworn in soon as Italy's 62nd Prime Minister in 68 years, today set out plans to overhaul elections and reform labour laws, public administration and the tax system. Now, if you think you've heard all that before, you probably have. Both of Italy's last two leaders promised reform, only to disappoint. So could this time be different? Well, if you look at the support that the government has, it's hard to see anything much that's changed. Mr Renzi, while youthful and energetic, is rather like his predecessors Enrico Letta and Mario Monti in not being elected. He has the same flaky support base in Parliament as Mr Letta, which automatically makes big reforms unlikely. At the same time, the markets have taken away the pressure for reform that they had been applying. This chart shows the simplest measure of how fearful investors are about Italy, the 10- and 2-year bond yields compared to Germany. Now, the 10-year yield taken on its own has today dropped to the lowest in 8 years, but the spread has dropped a lot less. You can see the 2-year spread here, the 2-year Italian bond against the German 2-year bond is back to its lowest since 2011, when investors briefly thought that the euro crisis had abated. The 10-year spread remains a fair bit higher up here, hasn't come down in line with the 2-year spread, whereas before the two moved pretty closely together. That suggests that there's a fair amount more caution going on about how long things are likely to be stable for. Still, investors no longer seem that bothered about Italy's leadership. Perhaps not unreasonably, they seem to think that it doesn't really matter who's in charge. The question is whether this is because the captain is irrelevant when the ship is sinking, or because the future of Italy is really being determined in Berlin and in Frankfurt, where the European Central Bank's based. Now, either way, the speed of turnover of Italian leaders doesn't usually seem to faze shareholders. Each of the bars here underneath the chart shows a different government, with the red line here showing Italian shares back since 1970 and the blue line showing European shares. I should point out that these are both in local currency, and actually up until 1999 the Italian stocks would have underperformed dramatically if you took account of how much worse the lira did than other European currencies. Now, there have been times when political stability was a good time for shareholders. You can see on here, for example, under Bettina Craxi in the late 1980s, shares had a stunning rally. But even then, that rally came as the rest of Europe was storming ahead too, having previously reached insanely cheap levels in the early 1980s. And the same went for Romano Prodi's 2-year government in the late 1990s. That's this section here. Italian shares rallied strongly, but not really by that much more than elsewhere in Europe. So stability in itself, we should also say, isn't necessarily a good thing. Silvio Berlusconi, was in charge here, oversaw the absolute collapse of Italian shares as bond yields soared, which is something, of course, which went into reverse once he was replaced by Mr Monti. Even so, since Mr Berlusconi was kicked out, shares have continued to underperform the rest of Europe. Even there you can see Italian shares up a bit, but European shares up a fair amount more. Now, much of this comes down to the makeup of the Italian market, which has no tech stocks and banks which are in terrible shape. Even contrarians find it hard to spot bargains in Italy. And the bonds will supply a lot more potential gains if Mr Renzi manages to break from the past and unexpectedly delivers. And if he does that, that ought to help the banks as well. But it would need a proper break from the past for him merely to survive long enough to be able to pass reforms, let alone oversee their implementation.